Hi everyone, I'm Veronika. I'm from 0100, which is actually a sister company of Vestberry, which is organizing this. So thank you for the space. We're a VC fund, and that's about enough about me. I would welcome to the stage the experts that we have for this topic. So we have Ashley, Lucia, and Francesco, and I would let them introduce themselves as they come in, so that we can get right to it. Sorry? Is it working? We can test it.
Hi.
Okay. Seems to be working. Okay, good. You will have two microphones, so you will just have to switch. I hope that's fine. Perfect. So we can just kick it off, probably. The buzzword of today is smart money. So VCs are basically expected to provide value, as we know. Let's talk about it a bit more. I will let you introduce yourself, but you can also continue with answering the first question of today, which is basically, what does value creation mean for you?
Sure. So, hi everyone. I'm Ashley. I am over at Autotech Ventures. We are a ground transportation and mobility firm based in California. We are early stage. I sit on the strategic partnerships team, which is essentially kind of like an account management and an investors relations team for our corporate limited partners. So my perspective will be coming from the corporate limited partner perspective. And how we provide value to our corporate LPs is not just about financial return, but it is also about providing strategic services. Like, we kind of function as a consulting arm. What we provide can be expertise, deal flow, research, white papers, just things that help push the LP's strategic initiatives forward, essentially.
Hi everyone. I'm sensing that we are competing with this building agents workshop, so thanks for everyone who is here. We'll make it fun. So my name is Lucia Cerchlan. I'm with Backed VC, which is London-based fund. We do seed stage funding, frontier tech, 350 mil under management, 100 portfolio companies. And my job there is to work with founders post-investment, and KPI is to help them to raise Series A. And in terms of background, I was in product for almost 10 years with my colleagues over there, ex-colleagues over there from Slido and stuff. So I'm trying to bring product mindset into productizing like some parts of the support and then preserving the human relationship part and trying to scale it.
Yeah, you're not gonna get rid of me. So you already know who I am. I've been working in venture for a while, Antemis, Boulderton, Greycroft, and now working with a few other people, but mostly building stuff, I guess.
Good. Okay, so let's continue and let's talk about value creation over time. So probably the market is shifting a bit, and the value is not created only after the investment, but already before. Can you comment on this, and how do you see this evolving and shifting in the current market?
I think there are like two different points here. So one is value creation for companies. And then there was like what Ashley was saying, which is value creation for LPs. It's like two sides of the same coin to some extent, because if you do one, you're going to do like the others and vice versa. But I think that you're right. For the investment specifically, there was like a moment in time where you were only generating value after you invested in a company. And that was like the name of the game, right? You were putting money and you need to have the company growing as much as possible, as fast as possible. I mean, we can argue that that wasn't always like the right strategy, but that was what has been happening for the last like 50 years. Now the reality, and that's why also we're building a lot of like these tools, you need to give companies something before you even invest. Otherwise, you're not going to be able to put money in the right companies most of the time. And some of the things that we are doing, some of the things that we're building, you saw this morning, Alex, with Kepler and all this like research tool. I bet that some of these things get fed to the companies even before you invest in those companies. You need to give them something to justify your existence. So this is it's a paradigm shift, because like there is like enough money out there, great companies, and great companies can choose, right? And they're only going to choose you if you give them the right tools, which is not no longer money. Because money, I don't want to sound like too much of a capitalist, but like there is like enough money out there, right? You can always find money if you really want to. But right, like reality is, and this goes back like to how you started this panel, there's money and money, right? And if you really want to be smart, you need to give them more than just an extra, bank account.
I totally agree with that, by the way. Basically, you want to give the LP who is investing with you, or even the founder you want to invest in, like a taste of who they will be working with. And oftentimes we do that by introducing them to each other and just building upon our network and giving them that taste of what it might be like.
Yeah, I'm trying to find something I disagree with, so we have interesting conversation, but unfortunately I agree. The way how we think about it is that, like, to your first question, what is value in the first place? We think about it about which direction founders run, and then how quickly they run, and like, can we help them to find direction and then increase the speed? And this is something that I think speak for itself, so we encourage the future potential founders that we might back to reference check us, to speak to our portfolio founders as well, because we believe that if the job is well done, it speaks for yourself. I'm also aware that a lot of deals are hyper competitive, so not always you have time to like provide like extra value up front. So that's why we think like the relationship and the value we provide to our existing portfolio companies can be referenced, and like the founders will know about it, and they will kind of know what to expect once they start working with us.
And there is like another funny thing that is happening. Like there's like a level of externalities that are happening in the last few years, where people do work they're not supposed, or technically they can also skip. So like you look at a company, the company doesn't move through the pipeline as much as you want it to move, but you still send them after, suggestion on how to improve the business model and follow up things, and maybe like you make like an intro to a potential client, even if you're not investing, right? That's value and things that like a few funds were doing 10 years ago. Right now it's becoming more of a norm, more of a habit. Because reality is, if you do that well, that reverberates in a good way in how many deals you're winning in the future, how many LPs you're winning in the future. Because like reality is like, it's all like a reputation business, like no matter what. And if you're happy like the ecosystem, if you're also creating value for the ecosystem at large, even if you're not investing, people are gonna be remembering you. Like the founder that maybe you didn't give like the money to is gonna go and start like a new company and come back to you after. It's not wasted, let's put it in a way. Even if like you can't really compute or like calculate the value, like just to put it on your LP reporting every year, it still add up to some extent.
Maybe just a quick follow-up on this, because this was interesting what you mentioned. So how does it reflect in winning the deals? So you mentioned that founders will come to you. How do you see the shift of winning the deals through some value creation in the first step, like versus like offering bigger tickets, better financial terms, versus offering a better other strategic value creation? Which of them is now stronger? How is it shifting?
I would just say founder referrals are very important for us. So and this is just repeating the point that I said before, if our job, the way how we support our current founders is done well, then our current founders will recommend us to their friends. And we think that this is a very strong, like high signal, very high quality deal flow. So this is something that, on your point, like founders coming to us, this is why, like there ton of other strategies. Like from our perspective, being backed VC, we are also known for running a lot of events, and we see events not just like, like fun, like let's meet and like greet friends and build the ecosystem, but we also see a lot of strategic value there, where we can take potential partners, I don't know, like corporate leaders, and we can pair them with startup founders that we know that need this introduction, put them on a panel and make this connection happen that way. But I guess that I'm skipping forward. I guess that we'll talk about it once we talk about the actual work, yeah.
All right. Nothing against what you were saying. I think it's also, there are like a few extra nuances here, right? Like, again, it's very hard to say, what is the real actual value of doing these things versus a number, right? It's hard to come up with a number. There are like a few things that you can proxy the number with, and there's this concept in business of goodwill, right? We always add in like in companies. We don't have it in fund, right? But goodwill is, is a founder coming to you first. That's goodwill, that's trust, that's brand. It's a bunch of these things together. Are you raising a fund? How much you like oversubscribed? How much you need to say no to people because everyone wants you? Like all these things can potentially be boiled down to, okay, I'm raising a fund, I've been doing my job well, everyone knows me, the returns are where they are, like where they are supposed to be. founders like give me like massive MPS, or like my scoring in the industry is very high because I'm adding value, that probably will result in LP wanting to back you like for the next fund. And if you're like 2 times oversubscribed, that says something about what you've done like in the like previous 3 years, right? But I don't know if you are like, if you're looking at things like slightly different.
Not really, actually. I think you took the words right out of my mouth. Essentially,
Too late.
essentially, I was going to say that it's difficult, right, to measure something so qualitative like strategic value, but it does come down to whether or not they're re-upping in the fund. If they liked what you provided to them and there's still a use case for them, then they'll probably reinvest with you.
Cool. Agreed. Nice. Maybe let's move on in the timeline and discuss more how do you see the value creation evolve over time. So let's look at the post-investment versus later support, and also maybe some experience with the early post-investment value creation and how you really moved a company.
Complicated question. I'm not sure that I had the answer that you're looking for, but let's put it in the way. Venture started off back in the 70s because there weren't enough money to fund crazy things, okay? There were like a bunch of people that wanted to build the next generation of whatever it was, cheap computing, tech, call it whatever you feel like. But banks in general were like lending them money, right? So like they had to go to someone that could see that in the future and get the money. And that was like the real initial value creation thing. As more people entered the industry, they became, okay, you know what, actually, if you are a fund that has been like a fund 3, fund 4 already, you have a platform team, whatever that is, right? And you're gonna have the companies doing BD, you're gonna have the companies hiring. And that was like the normal, so like, playbook in this space. You have people going out there and look for your next CPO. You have people going out there and talk to Oracle so that you could sell your SaaS thing. And then you had people, which right now we're shifting into like the new wave, helping you exit in the company, helping you finding a buyers. And then you have people like me, Lucia, and actually like, helping you, looking at everything tech related and GTM and everything else to make sure that, once you get the money, use them well. Because like to the points that Philip was doing before, doesn't say that you're gonna get follow-on money, and like that decision is like sometimes it's not like belongs really to how much the fund wants to fund you. There are like a bunch of other factors that goes in. Some are risk considerations, some others are market, some others are like LPs or portfolio construction. So I think that like the shift is at some point it was much clearer because like the market was smaller. You just needed more money to go faster. That's no longer the case. So, I mean, we need to invent new ways to help companies in such a way that they're happy to take our money, but like above all, they are in a situation where they can get someone else's money as well, like going forward. Because if we keep backing our own companies over and over, that's a self-fulfilling prophecy, right? Eventually, and these things could become very big or very small depending on what the market is going to tell you. But I think it's also like a good external validation point where someone else look at the company later on, and CVCs are, or like, corporates are a good validation point because they might look at your business and say, oh gosh, this is something that we've been thinking about building or backing for like 10 years. No one is done it. You're doing like these things very, very well. So again, I think it's shifting towards services more and more.
To his point, I agree there as well. That's the importance too, I think, of making those introductions early between the LPs and the startup founders so that later others can invest alongside you. It's not just about investing in your fund, but they can invest in the startup as well, separately.
It's a complicated question because this is the topic of the panel and we can break it down in we can dice it and slice it the way how we want. Maybe something that would be useful is that we think about support that is reactive and that is proactive. The reactive support is like the bare minimum. This is like what startups ask you for, and I guess every VC does it. Proactive support comes you get better and better the more you do it. So for example, you have different not pivot points, like you have different points in a startup journey that you can like really nail in terms of startup support. So for example, when you have pre-seed and seed startup, what you see the most is, can the founders achieve productivity together? So you can ask yourself, like, what can you do from the support side to help them to do that? Can the founders work together? Do they know like how to hire, how to surround themselves with people who might fill the gaps? Do they understand what is their strength and weakness profile, all these kind of things? You can be very influential there as an investor. Then if you move on, you start approaching Series A, then you start talking about product market fit. You can do a ton of proactive things there, like helping them to introduce them to strategic partners, design partners. You can use and leverage your network to open doors for them there. If you have any kind of experience doing that, you can help them to basically pivot and play with the product in a way which you can be slightly influential in like trying and helping them to reach product market fit. Then Series A, like fundraising Series A, you can open your network. It can be your network, but it can be also a network of the whole founders that you have in your portfolio. Like these are the ways that I'm just like sharing with you how we think about like scaling it and productizing it. And then you can go further. Like for example, for Series B, it's all about like leadership, founder leadership, like basically reinventing who you are as a founder. So there are a lot of coaching ways how you can help them, like the hiring, like managing managers and all this kind of stuff, but we don't do proactively Series B. So there is a lot we could unpack, but this is like one another angle that we are trying to look at when it comes to portfolio support. What can we do proactively and what kind of patterns we see in our portfolio companies, and then we can like preempt that and make sure that the other companies that are coming after that will be already prepared for these kind of challenges.
Just maybe a quick follow-up. You mentioned the patterns that you notice in the portfolio. So what are the recent patterns that you noticed that are the biggest areas where they need support and help?
It really depends. Like, it's a great question, but it's a very broad question. So I'm trying to think how to be useful here. So the sectorial patterns that I mentioned right now is something that we see over and over. We do mostly seed investing. So sometimes we are like very early, where you just have two founders and a pitch deck. So there are a lot of questions about like the productivity. And then like later we have a lot of questions about product, and then about like scaling founders as managers. You also can dice it on a sectorial level, right? So we see biotech companies, like we invest in biotech, future of health. We have some manufacturing, software, and finance, and all of these have very different kind of challenges that are present for them. I would not want to speak on the sectorial challenges because we do have experts as part of the investment team. So, for example, I don't work with biotech portfolio founders, but we do have a team investment team that does that. I think like the sweet spot for the role that I do is mostly understanding how to scale a company and then like try to be helpful on that front.
And I think that you are 100% right. Like, but like there are like a few things that are common across any vertical, right? Like there are KPIs, metric, call it whatever you feel like, actions that are very standard. So like when you get to Series A and you have like call it like a VP of product, you get a CTO, and then a Series B, you get a CFO. And then, after 5 years, you need to get specific, strategic partnership. And then you need to maybe move from Lovable to Snowflake at some point because you might need it, right? Like there are things that are becoming slightly more playbookish, I guess. Like people are doing the same thing over and over. But I like what you said before because like it also connected. I don't know if Ben is here, maybe it's not here, but like it connected to the stuff that we were talking with Ben before about the idea of having weekly portfolio updates is not for the sake of it. Okay, it's like if you get the Slack notification and you don't do anything about it, just like wasted time, computing resources, and engineering time. Where things get interesting is where what you were saying. You go like from reactive to proactive. You see the update and you reach out and say, okay, company X, actually, I saw that, your board member told me, or like the system told me that you've been last month a little like, slower in getting revenues. By the way, there is this thing that you can do. And some of these are codified in our VC DNA. You know that again, at VC Series A level, you need to get a CFO or you need to get a CTO. Some other things are becoming slightly more possible and slightly more accessible because we have more data, we build into that. And even the partner goes on holidays for that month and you don't know what is happening with the company, you're still getting the data, you're still getting the board deck. And that is still, fits your model and tells you, oh, actually, Lucia's companies, they are doing much better than, we were thinking. And maybe that's a good time to bring them in and show to the rest of the portfolio how they're doing things, right? So again, it's much more. I'm thinking of a better word, but like proactive is actually like a very good one. You don't wait for a quarterly report to do things, right?
And just add to this, I think product and technology plays a very significant role right now. We talk a lot about knowledge diffusion in a team. So if we have an investor who is on a call with the founder, how do we distribute this knowledge for everyone so everybody can be proactive? We can talk about that topic too. Like we are creating like certain workflows where we capture transcripts. How do we share them on a team? Like how do we make it findable? Like what is the source of truth for us? Those are all the big questions. It's not that difficult to solve it anymore because there are a lot of great products. And I think it's like once you do it, the impact it can have is massive because now everybody can be up to date and everybody know how to contribute with their skills to the portfolio support stuff.
And it's very easy to find commonalities between, like especially if you are like a generalist investors, you might like, never think that a fintech company is similar to an healthcare company when it comes to how they go to market, right? But actually they might be because they're selling to banks and hospitals. They're not too different, beast, I guess. So you can probably draw from one sector and apply it to something else. But usually what happens in many funds is that you have one guy doing fintech investments and one guy doing healthcare investments and one guy doing energy. If they don't speak to each other, and it's not that communication is broken, it's just that 5 years ago, you couldn't do that. Because you had like to join a call with your EA and he or she was taking the notes and it was like missing a specific quarter, a specific thing. Like right now, it's just open up Granola. It's gonna do like the entire job for you. And then like when you feed it into Kepler, Notion, whatever knowledge base you have, that becomes like a centralized repository for everything that the fund is and things, right? That's powerful.
Good points. Maybe I will follow up on this because you mentioned how it's important to coordinate and connect people. So how do you typically coordinate with other investors as the portfolio companies go across stages? There are more investors involved, more parties, more LPs potentially for you. So how do you coordinate across the multiple stakeholders to ensure the most value is created and it's not double work, let's call it?
I would say that we leverage that network by pulling them in, especially for diligencing a new startup. Our industry that we're in, ground transportation and mobility, it's very niche. So we rely on the knowledge of our LPs in this great network we've built. So when we do find a startup that's interesting to us and we want to learn more about it, we reach out to these LPs, and that provides value that's you can't quantify it. Additionally, later on, investors may co-invest together in SPVs without us being alongside them. But yeah, I would say it's really about leveraging that network and their knowledge.
There is still some decisions that have to be taken when you do the investments, right? I feel like the worst thing that could happen is that 5 people reach out to the same company at any point in time. Because that's it doesn't matter how much technology you throw at this problem, you're gonna have issues, right? What you can do though is centralizing efforts and having one single bottleneck point that can help a specific company. And then in that case it works, because if we are on the same team, and I noticed something in one of her portfolio company that actually might be good for her to know, I wouldn't go to the company straight away, right? There is still a decision that has to be taken when you invest in a company. Who is sitting on that board? Who is helping that founder specifically? Is that, is your fund supporting a platform approach, or is it's a small fund that doesn't, they cannot afford 3 people extra to do hiring and BD, but maybe it's all investment people doing the work. But in that case, it's just creating the baseline and then having one single person interacting with that company all over, in time. And that's also when it comes to do things, it's actually better, because the moment that you have the relationship between one person and the founders, that's where you build trust in time. If you keep having 5 analysts and 2 partners and me coming in and say, oh, you should do this, it's very hard from the other side of the fence to take all the feedback and digest it, right? There has to be and I know that this is going to be like controversial, but it's important to have the bottleneck. Like, we are all on the same team, and we need to push all the companies forward, but eventually it has to be like a single person talking to the founder. It can't be like getting 5 inputs from 5 different people and potentially different inputs, right? So.
Yeah, absolutely agree. And if you want more people to speak to founders should know like what is their role and why they should reach out. So I think there is also value in introducing the whole team, but like knowing who is your point of contact. I think I have nothing interesting to add on that question in terms of like the industry is so connected, so we investors talk to each other, so that was already said. But something we think about is what is founder experience? Because we know that a lot of VCs are doing similar activities in terms of, I don't know, like talent network support, introduction support. And you can see it, for example, for Series A, where every investor has their own spreadsheet and then poor founders have to navigate through the spreadsheets. And we don't have solution yet, but we very proactively think about like maybe there is a role of lead investor to provide founders with certain tooling that can be adopted by other VCs as well. So not to think about especially like the fundraising experience from only fund experience, but also from an experience of a founder. And I think there is opportunity for all of us to collaborate, and perhaps like that could be tools developed that would be used by founders, and investors would contribute to that. So if anybody wants to talk about it, please find me, because I'm thinking about it proactively now.
Super interesting perspective. So don't agree that you said you don't have anything interesting to add.
I mean, I meant just on that. That was already said.
Got it. Maybe on topic that was a bit mentioned by a few of you, what is the role of the relationship that you either have with the founders, with the LPs? How do you see the importance of the relationship, and how can you see the relationship itself and its strength translating to the value that you create?
Okay, I can start with this one. So our ethos is human-centric fund, and that means that we really try to build like very deep relationships with founders, because it's not only about the times when things go right, but it's obviously about the times when something is not going right. And if you don't have a strong relationship, then there is a big chance that you will not know what's happening if it's not that positive. So this is something that we try from the very beginning. I mentioned events, like we organize a lot of events that are external, but we also organize a ton of events internally just for our founders and for community of founders. And when we see, like we try to do it every 3 months in our office. So when we see them every 3 months, there is already something that's like the relationship that is building not just between investor and founder, but between the whole team. So we find it very, very useful. And then obviously there is like a different set of relationships between investors and founders, but yeah, I guess that they should comment on it. Sorry, can you please repeat the question? What was it?
The question was about the importance of the relationships
and
how they translate into the value.
Yeah, so yeah, of course. So sorry. So the first one is, do founders tell you the important things, and for them to be able to tell you that you have to have trust. And then I think it also goes into like deal flow generation potentially, because I think that's a huge one. Like if you have a good relationship, they will be open to open up their network. And we also think about it from perspective of how do we open our network, not just like for particular founders, but how do we help other founders to open up that network? So like literally create this like super connected infrastructure.
It's very similar on the LP side, you know, especially with the corporate LPs. We're not just taking their money and then never talking to them again. And maybe it's because we're in fundraising mode ourselves right now that I'm thinking about this so much. But resources and develop relationships with people within the investor's firm. What we try to do is create a relationship, like, and have a champion over at the investor, someone who will like speak on our behalf, and someone who will like advocate for us and want to come back to us and come back and invest in us. So I would say, yeah, we are able to share each other's resources though.
I think that this goes back like to the first question that you asked us, right? And I think that you say relationship, and I keep hearing reputation, which for me are two things that go like hand in hand. If you build enough good relationship, your good and healthy relationship, your reputation might go up. Vice versa, if you're not doing that, that might go down. And it also works like on the other side of things. Like if your reputation is very bad, your relationships are hardly going to be like any good, right? And this goes back like to your point. It doesn't matter if you are like a data-driven founder or not. It's still a human business, whether we like it or not, right? For a bunch of like different reasons. We're still trying to assign a value to something that is like intrinsically very hard to measure, and that's fine. Because like eventually when you negotiate your bonus at the end of the calendar year, you need to tell your partners, okay, I've done X, Y, or Z. So you always find proxies that could say something about the work that you've been doing to help companies succeeding, but it's hard, right? And like that relationship, again, you can see like a few of these things popping up. And I mentioned before like some of this, but like it could also be, there was like a beautiful post probably like 5 or 6 years ago, of this like GP that was saying, the only thing that I care about when it comes to relationship is being top of mind for these 5 investors. If they call me every time that they see a company that could fit my thesis, it means that everything I can do relationship-wise is perfect, nothing else. Okay, we can argue whether this is like the right approach or not, but again, relationship, reputation, these are like all things that are very hard to like to completely disentangle, and are very hard to measure. That's the reality. But like eventually, if you really want to boil it down, this could be, are you returning more money or not? But it's a very simplistic view of the world, right?
I finally remember what I wanted to share. So I'm like, there is a huge potential in like all the talk that we have about product, technology, automation. The way how we think about it is that if we can make certain tasks automatic and we can scale our support, then we can free ourselves to spend more quality time with founders. And I think this is like very important, because instead of like, I don't know, like trying to find out like who is the best person for an introduction, and instead of spending an hour on it, imagine that you have a technology for it, and then you can literally spend like one-on-one time and help them proactively. So relationships are crucial. I think they will stay. And I think technology will enable, if it's done right, technology will enable us to have better quality relationships and spend more time with founders.
But if you think rationally about it, this is what happening like to any other industry, right? You don't want to do customer success anymore. You just want to take what everything like could be easily answered and give it to a chatbot, and then like having like 5 humans only focusing on high value, strange problems, right? So if you can take some of these things off your shoulder, that's better for everyone. Like you're spending, like fewer money that your peers are giving you. You might hire someone else that can do like a slightly different job or a better job. You hire more founders. You can go from 10 companies to 60 to 100 like in 3 months time, and that's like scaling the thing. Like we used to say that like VC is not scalable because like the only way to do things was like adding more humans to the stack, and that's where I don't know if there's like any insights here, but like Insight was very famous 10 years ago for having an army of analysts that was going under and call every company, right? And that could work if you're like a 25 billion giant. If you are like many of us, tech is the only way to go, I guess.
Got it. Good insights. It was said many times that, you all agreed that it's about the relationships and it's hard to measure. Is there a way to measure, or how you try to make sure that you actually create value for the founders, for the LPs, for anyone? Is there a way that you try to make sure that it actually brings results?
I think, like it's been said, it's so difficult to measure like strategic value other than ultimately if they're coming back to you, if they're coming to you to pass deal flow, to reinvest. The best you can do the best we can do at my firm is to track all of our interactions on our CRM. We just have a single source of truth as well that we can refer to. But otherwise, it's very difficult for us to quantify.
I must take it. Okay. So I'll stick with it. So there are a lot of ways how you can measure it, but I think what ultimately matters is like what are the milestones that the company can reach, and it's not always just your job, obviously. So that's very humbling. We were doing NPS before. We were asking founders once a year what's the NPS score. It was good, but we didn't feel like it was telling us something. Now we are thinking about doing the superhuman founder. Superhuman is like the email client that I'm sure everybody knows here. So the question is like, can you live without it with like certain parts of our support? But I still think that it's very artificial and doesn't measure much. We have a system where we actually log all the tasks and all the help that we help how we help our portfolio founders on Notion. So every company has their own page and their interconnected databases, and we are able to see like how much we do for every company, which again doesn't provide any ultimate number, but at least it gives us a sense like how much we are helping certain companies, and then we can see whether the time and amount of activity spent on that company, whether it's actually if it's a company we're doing it for, if the company is not growing as fast as we want. And then for me, the big one is like ability to fundraise, ability to raise Series A. Again, not something that I can influence 100% directly, but there is a certain push that you can do, and then exits, which like the DPI of the fund is basically the ultimate, I think, number to measure. But maybe, I don't know, maybe you have more ideas what could be measured?
I mean, we have 10 minutes, so like I better be provocative here. No, there is no way to measure any of this. And the reason why I'm telling you this is like, this is all true. Okay, you've been saying reasonable things that I believe in as well. But I'm also telling you there is no way for us to go back in time and see what would happen to that company if you didn't give them the support or the money, right? So we are making assumptions here. And things that you do is like, okay, I'm helping company X. There's like another company Y that is doing like exactly the same thing. I mean, Superhuman wasn't the first one, right? And it wouldn't be the last one. But is that growing much faster than like everyone else out there? Now, without taking anything out from the founders, amazing people, and like they are the one building the companies and doing most of the job anyway. But you might probably argue that, you know, like a tiny part of their success is like you helping them do things faster and better, right? And again, we cannot live like in a world where, you know, you rewind everything 5 years before and say, okay, let me try to give money to a different company and see what happens. So we'll never know exactly whether, you know, things are going like in the right direction. There are a bunch of academic studies where people have tried to disentangle the effect of VC money and VC support versus, you know, companies getting their money or not. And some of the things they found, and again, there are technicalities and issues like in the way that people model things, different story. But you can show that VC add value. Not all the VC. Not all the time, but there are specific cases where actually, if you gave the same money to someone else, it wouldn't get to the same results, okay? So like probably it's part of the, like the good part of, you know, whether a company is successful is definitely the team, it's definitely the founder, right? Then there is luck, there is market, and there is like investors, right? And where you will see that these things is real is where things go south, where people are not adding value, but are destroying value. And it's super easy for like an investor to destroy value, much more than having that value itself. Do you want a number? I can't give it to you, sorry.
Okay, so I don't want a number now, but I would want a story, a success story, maybe from each of you of successful, where you feel like you added value and you had like good direct influence.
For us, there's several stories I can think of where our startups partnered with our investors, led to success. There was one where one of our startups partnered with a manufacturing LP to deploy new technology. There was one where they created a parts sales partnership with an aftermarket LP. And then there have been several of our startups where their first and sometimes largest customers were the LPs.
Like the obvious answer is like the introductions we made or like some kind of like direction we provided. But I think something that is not, it's common but not as common is what we've done for founders is that we organize founder retreat every year in Portugal. And the value there is that we provide space for founders to stop and to strategically think what they want to do. And I think obviously it's not like a direct impact on a company and I can't measure it, but we put together 40 founders for 3 days and we give them basically freedom to either do nothing or to think about it, being surrounded by other very high performance people. We also craft the content in a way that can help them based on the challenges we know they have. And I think this is a very highly valued activity for founders, just to be able to stop for 3 days and think really critically what they are doing and how do they want to spend the next year. And like a silly detail, but we also ask them to write on an envelope a letter to themselves, and we send it to them six months later, and then they can just like be like, okay, so this is what happened in this retreat, and this is like me talking to myself like from the past, and like just providing these spaces for being able to be a little bit more strategic and slow down.
This is like a tricky question, because like we haven't really defined what, you know, success is, and sometimes it's just helping the founder get in a moment, in a spot where it's okay, because like we need to admit that like this is like, you know, tough jobs, and like they like it doesn't always go in the expected way, and there are stories out there, and again, not naming funds or people, where the guy has been building for like 4 or 5 years, sacrificing jobs, family, whatever, right, and eventually, you know, exiting the company in the way that you think, right, and I know investors that instead of getting back, you know, penny on the dollars, they actually go there and say, you know what, actually founder X, keep it all. Like, honestly, like, it's not gonna move the needle for us anyway, and you'll be better off and you're gonna be like rewarded for that. This is not the success that you're thinking of, but this is a form of success for the founder, for the ecosystem, and for the investors as well. So like sometimes, which is counterintuitive, is sacrificing the short term for the long term, sort of. And again, that is like always talks to, you know, helping people proactively and making sure like relationship and reputation and branding goes hand in hand with returns. Because eventually that guy, can you imagine who is gonna go back to if he start like a new company? It's probably gonna be like the same investors, because like the way that you treat that guy, even if it was like in your capability to say, you know what, prefer shares, I get like half of that thing. And this, again, probably like close the loop. It's hard. I mean, if it was like a single thing that you can put in a platform and you can spit out a number that is not like an NPS, it's something different, everyone else will do like the same thing, right? But the fact that you have someone like her or her like doing completely different stuff, you know, one to another, it means that different funds and different strategy, and they're all working for themselves. But again, I never heard of the letter thing, but that's a pretty cool one, honestly. Like, it's a tiny thing, but it's, yeah.
Good. I think we have last 3 minutes, so last question for each of you. And that's, what advice would you give other VCs? What do you think they should reconsider? What do you think that VCs are making mistake or should not do in terms of trying to add value, but it brings not as much value as they think, probably?
I think it depends from firm to firm. But for us, I would say if you're going to add bespoke value, then to think about ways you can scale that in the future with more ease.
I think every VC should build. So I think there will be tremendous value if everybody tries to build something and then come with that experience to a founder. And I think that would create very different levels of empathy.
Don't assume, ask. Because what we do most of the time is assuming that we know everything about a company, but we don't. And most of the time, if you just ask the founder, what do you need? Or what do you think you need? That's much more powerful than assuming, like, you know, making 20 assumptions and go like straight into that. And sometimes, and again, this goes back like to relationship. The more you ask, the more you get back. You build a trust, you build a relationship, and eventually it's going to be almost intuitive. But conversation, especially in tough times, is probably what really makes like an investor in a portfolio, because it's always easy to, you know, jump on the winning ship and say, oh, we did it. But you also value, you know, like when things go south.
Thank you very much, everyone, for today.